Good evening, everybody. Welcome back to another episode of the Coffee Hour, and happy Friday. All right, thank God it's Friday. TGIF. All right, in case you didn't know what TGIF was, there it is. So for all those out there who are going to be taking a nice weekend off, congrats. We made it another week. The market didn't implode on itself, so I think we're doing A-okay here. So today's episode is going to be kind of a mishmash of stuff. To be honest, there's really not a whole lot that happened today in terms of news that I have found. So we're going to just kind of swing it and see what we can get. All right. So we're going to watch a couple clips. We're going to watch a clip by Tom Lee. He's actually had a few things come out, so I definitely want to cover that stuff. And we'll be kind of listening in more about this, commodities, right? All the rage right now is metals. So I'm going to be covering just a video on metals. Hey, Dividend Sith, welcome back. Execute order 66, as they say. All right. A good soldier follows orders. All right. So we're going to be going over just a couple things. If you guys have any questions, always drop them into the chat. All right. If you guys have anything ETFs you guys want to review, I will pull them up towards probably the end of the stream. Again, this stream is probably going to be a mishmash of stuff because there just wasn't really a whole lot of stuff to cover today. So with that being said, let's hop into it. All right, guys, let's hop into it and see where we end up. Okay, so welcome back as always. So the S&P 500 over the last 5 days, we kind of traded flat. We're down 65 basis points. Okay, so again, the S&P 500, depending on what you believe, is kind of like in this wedge pattern, right? Over the last couple of months, or not couple of months, but over the last couple of weeks, it's kind of just been trading flat. It hasn't really been going up or down. So there's this kind of thing out there with technical analysis where the S&P 500 is trading in this wedge and it's getting closer and closer, and we should see probably in the next week if the S&P 500 is going to go up and continue the bull trend, or if there's going to be a breakdown in the S&P 500. Okay. Now that has to do again more with technical analysis. I don't really do too much charting myself, but it is something to keep an eye on. All right. It's definitely something to keep an eye on. I really thought that this was going to be it. This was the Davos meeting, Trump talking about Greenland, all that stuff. I really thought that was going to be the catalyst that was going to send us down. Not so much. Skeptic, hey, welcome back, man. And yeah, I wish I could have a nice glass of scotch myself, but I think I'll start off with the coffee. Or maybe I'll just add the scotch to coffee. Anyways, guys, moving on, right? Okay, so for Bitcoin, again, not really doing too much over the last 5 days. Still trading kind of down, still trading kind of flat. It's still really choppy, but what can you expect? It's Bitcoin, all right? There's still a lot of chatter out there that Bitcoin is going to have this really violent move to the upside. Don't know when. People think that it has been really, really, stable these last couple of months. And there was an interesting point. That I heard. I believe it was from watching a Michael Saylor interview, but basically he said people are freaking out about Bitcoin, and the last all-time high was about 90 days ago, right? Probably about 100 days now. So it wasn't that long ago that Bitcoin was at its all-time high of 125,000, give or take a couple of bucks, right? So, people who are freaking out, they're probably the tourists, they're the people who bought at the top, didn't really know what they were buying. And now that it's down, 20, 30%, now that everyone's kind of freaking out. But again, long-term holder, long-term thesis, long-term conviction, Bitcoin will be just fine. All right. So again, trading flat. Gold. Man, you cannot stop gold, guys. You cannot stop the metals. Up 8% over the last week, all right? Over the last 5 days, up 8%. Over today, up 1.37 basis points. And again, year to date, up almost 15%, all right? This is the first month of 2026, and gold is killing it right now. Of course, we got to just talk about silver. I mean, look at that, guys. Look at that. Can you see? I hope you can see this. 6% today, just by itself, 6%. Silver is just freaking mooning over here. All right. Year to date, 41%. All right, 41%. Silver is just having its spotlight. It's in the spotlight. Everyone wants to buy silver now. There's a lot of inflows into silver. Is there going to be this crazy blow off top? Look at this chart. Is there going to be this really crazy blow off top and then, a downward trend? Left to be seen, right? We don't know. The only other time in history that it was like this was around, I guess it blew it out of the water. 2011 would probably have been it. But it's just, look at this chart, guys. It's absolutely crazy. So who knows when that correction is going to happen or that pullback is going to happen. If you love silver now, you'll probably love silver when it's a lot cheaper, right? Or if you're just trading it, right? Okay, so let's hop into some news again. This is going to be kind of a hodgepodge of stuff because there really wasn't that much news today. All right, there really wasn't a whole lot today, but we're going to listen to our man Tom Lee, who I always like to listen to, and he's talking about energy and basic materials are the top sectors picks for this year. Okay, so let's listen in.
Tom Lee, as I said, is with me now as we turn back to the markets. He is a CNBC contributor, of course, Fundstrat Global Advisors. So it's good to see you.
Great to see you, Scott.
It's been a turbulent week.
It has.
Is it portend something that's going to come forward here for us?
Well, part of it is, of course, as you know, we're in earnings season and markets tend to be volatile around earnings. I'd say that some of the high-profile declines like Intel look bad over a one-day period, but Intel was $17 a year ago. So to me, it doesn't surprise me that you could see some of those stocks have done really well get punished a little bit on earnings.
I mean, this is a hard one to say it's representative of anything. I mean, the company's obviously been challenged. They have the government backstop in there, and the stock was up a ton going into the print. As we turn, speaking of the prints that matter next week, the mega caps, which you still love, but not quite as much.
I mean, we still like the Mag 7 and the mega caps because they're great earnings stories and they have a lot of visibility. But as you know, our top picks this year in terms of sector is energy and basic materials. But as far as earnings stories go, I think next week's critical because you got most of the Mag 7 reporting.
Tom, you're crushing that so far with that call. Energy and materials are the two top sectors.
Yeah.
All right, just real quick, you guys heard that, right? Next week is Mag. Some of the Mag 7 earnings for next week. We have Apple, Meta, Microsoft, and Tesla. Especially if you're an investor in the AI trade or broad market, then you're definitely going to want to hear these earnings reports, or at least hear what's coming from them. I think it'll be very telling. Last earnings season, I mean, they did pretty well with the exception. I can't remember who did not do well, and I want to say it was Meta that didn't do well, but I could be wrong. But anyways, even last year, these reported great earnings, right? All of the Mag 7 pretty much reported pretty decent earnings, and we still had some really bad sell-offs. So is that going to be the case this time? Left to be seen. I think some people, I think money or liquidity is coming back into the market, so maybe the shakedowns or shakeoffs won't be so bad as compared to last time. But I think if you're trying to probably swing trade these, might be an opportunity, but be very, very careful because usually during earnings seasons, it's always pretty volatile, always volatile. It can go any way. So not everything is always going to go up, right? And, you might be surprised and there might be just a sharp decline. So let's continue listening.
Why were you leaning that direction as the year began?
We were betting a bit of mean reversion taking place in 2026. One of the things we identified in our 2026 outlook in early December was that energy and materials underperformed over the last 5 years at a level that in the last 50 years have marked turning points higher. So we were betting that so much of the bad news was baked in that they could have okay fundamental years, but the stocks could do really well.
I feel like you were on the right path as it pertains to small caps and the Russell just a little early. Yeah. I mean, remember, let's remind people, last year you told me up here that we were going to have a 50% gain in the Russell. Now, obviously, we didn't have that, but the Russell is almost outperforming everything else over the past year. And in 1 month, it's up 5%. Yeah. Is that going to continue?
Yeah. One of the things we talked about a lot about last year was that when small caps turn, it tends to be a multi-year. In fact, it could be up to a 12-year period. So the last turning point for small caps, and on a relative price to sales last year or price to book, they were at the exact same point they were in 2001. that was a launch point for 12 years of relative outperformance. So I think small caps benefit from a Fed turning dovish, possible M&A wave coming, an ISM turning back above 50, and then catching up to where EM, because EM did really well last year, and small caps usually track that. It didn't.
Fed turning dovish, we have a meeting next week, in case you didn't know, and not expected to do anything. So maybe not as dovish as people thought several months ago. And by the way, as we look at prediction markets, as we think about who might be the next Fed chair, BlackRock's Rick Rieder is now the leading contender in prediction markets. There's Kalshi. We, of course, have a partnership with them. 52% leaning towards Rick Rieder. We shall see. Do you care? How much you think about who the next might be?
I mean, it's important because it reflects the market. Market needs to respect who the new Fed chair is. Rick Rieder is somebody that markets really do respect. So, as you know, the Fed has to communicate not only with the White House, but also with the bond market. And I think Rick Rieder's experience in the markets world makes him very credible.
But you're not expecting anything next week, right?
All right, we're going to skip the rest of this. I don't know. They're not even really talking about energy or basic materials. Okay, so, volatility next week, guys, so be prepared. And this is a big deal right here, the U.S. Treasuries. Of course, we like to see when they go down, right? We like to see when they go down, when there's red in the Treasuries, because that means the rates are coming down. For any new, viewers, just so you guys know, most of these, right, when we talk about the federal funds rate, controlling the interest rate, it controls pretty much short term, right? The short term. But when it comes to the long term, long-term debt markets, usually they follow, like mortgages and things like that. Usually they follow the 10, 20, and 30 year. All right. So we like to see treasuries come down, this percentage. These are the interest rates. Now, another reason why that's a big deal, especially for the 10 years, because that affects commercial real estate. The 30 year more or less is about, for homes, right? These rates obviously just influence the mortgage rates. They aren't an exact one for one. So just in case you guys weren't aware of that. So let's listen into another clip about gold and silver extending its record run and just hear what they have to say. What's up, Victor Sank? Welcome. And we're just going over some news.
Meantime, gold and silver settling at new records once again today. Gold getting within $10 of the $5,000 mark. Silver now north of 100, and Treasury yields falling across the board. India's holding of U.S. debt falling to 5-year lows as the country looks to support its own currency and diversify its reserves.
You guys are hearing that, right? Let's replay that. That was very important. Let's replay that.
Treasury yields falling across the board. India's holding of U.S. debt falling to 5-year lows as a
India is dumping U.S. debt. All right. Say that one more time. India is dumping U.S. debt, right? Not to be a sensationalist, but that is a big deal, right? That is a big deal. India is part of the BRICS, right? And they're moving away, and the BRICS nations or the BRICS members, they're moving away from the U.S. dollar. So again, that Davos meeting, and I keep talking about it, even though it's kind of concluded, it's kind of over. It was a huge deal, right? Like before internet, before, YouTube and all that, that was like the elitist, right? The global elites conference. That's the conference that we had no access to. And now we can just see videos, see interviews, see the thing live, right? See clips of it. So we got to see into the minds of how these nations, right, these nation states are working and what they're thinking about. The U.S. came in like a wrecking ball, to basically try to reorient the entire world, right? It's us versus, you're either with us or against us. That's essentially it. And, now you have a big country like India, massive country, that's like, you know what, we're going to dump some of this U.S. debt, right? Because they're losing trust in the U.S. dollar. The United States debt right now is at 38 trillion bucks and it's climbing. It's probably 39 trillion, right? That is an obscene amount of money. That means we're spending about $1.2 to $1.3 trillion a year just to satisfy the interest on that debt. Absolutely insane. So I just wanted to point that out. Again, when you hear these little lines, these little tidbits, right, we would have glossed over this, but that is a huge deal that India is kind of dumping U.S. treasuries.
The country looks to support its own currency and diversify its reserves. So what do these moves
and diversify its reserves? What do you think that means? You think they're going to be buying, the yen or Russian ruble? No, they're buying gold. They're buying gold. That's what they're buying. Okay, so big, huge deal there. Okay, so I really think people need to pay attention to something like that because it can impact your investing, can impact your portfolios.
say about U.S. assets. And remember, the theme at Davos this past week was European officials, non-U.S. officials, officials from other countries saying, we want to diversify away, that there's a new world order here. We can't rely on the old rules anymore.
There's no question that if you were, if gold was significantly lower levels, you came out of Davos and said, I need to go buy gold. Gold's not at lower levels. Gold's at much higher levels. And so news flow aside, and as someone that's been talking about gold for years, and I expect I will be talking about it for years, we talked about central bank reserve ratios, and I mentioned China at 8% when Germany's at 80. I still think these things take gold higher. At where gold has gone, and I think big round numbers like 5,000, I think an 83 RSI, I think the overexuberance here, I think Davos, I think Fed, I think Venezuela, I think Iran, I think all of these things mean I think we're going to see 4,600 on gold before we see 5,100. I think we're going to get a 5% correction in gold. I was selling upside calls in GDX. I'm not, again, it's a trade I'm really happy about. I think the miners continue to be more profitable, more efficient, and we're still not with the right gold price input in models that's incredibly powerful in terms of the valuation. But again, I say be careful here. It doesn't mean that long term. I think every money management firm is wondering, do we have enough gold? And I think the retail sector thinks they're very underweight gold. I think it's going higher, but I think this trade has gotten, in the short run, very short run, overdone.
Yeah, and I think everything that Tim was talking about with other countries, geopolitical, their sanctions have stopped people from moving money around, so they're using gold to do that. Diversifying away from U.S. treasuries. China's been doing it for 12 years. Russia's probably been doing it for the same amount of time. India's doing it. It's shorter-term process in Japan as well. But when you look at supply-demand deficit, silver's the only one that you could actually, because it's an industrial metal. Mm-hmm. And they miss by about 200 to 300 million ounces per year. So if you're looking for a reason to buy it at these levels, other than emotions, silver's probably the metal that you stick with.
It's an industrial metal, and also we were talking to John Champaglia of Sprott yesterday, and he was saying that there is some substitution effect because gold is so high. Indian customers, for instance, aren't buying gold; they're substituting it with silver, and I thought that was really interesting, Mike. That idea that some prices are so high, so you go down to the next level of metal. We're also seeing that when it comes to aluminum as a substitute for copper in some applications.
Well, yeah, we have exposure in one of the discretionary funds.
You guys know who this guy is, right? You guys know who this guy is. That's Mike Coe, all right? Part of Titles. So Mike Coe had a life before Title, all right? He had a life before YieldMax. He was a CNBC contributor for a very long time. Actually, before he was even a part of YieldMax, the YieldMax team, he actually was talking about msty way before. So Mike Coe's been around the circuit quite a bit, all right, around the block a couple of times. So let's continue. I just thought that this was funny. I didn't even know he was going to be a guest speaker here.
Funds to basically the whole complex. We've got GDX, we have GLD, we have SILJ, we have Southern Copper. I will say that at some point I'm kind of with Tim here. It's getting into this moment where I'm really looking for that downside reversal day. That's that situation where you see it open, it gaps open to a new all-time high, and then closes sharply lower. When I was back on the NYMEX, that was typically the most bearish pattern that you could see in a commodity. We do feel like there's a lot of enthusiasm. Look at SLV, the ETF. That thing traded 2.9 million options contracts today. This is something that, 500,000 contracts 6 months ago would have been a big day for this thing. So, there's a lot of exuberance, and I think that's something to keep an eye on.
Yeah, I'm not really surprised to see BRICS players continuing to look to diversify away from U.S. Treasuries. I don't think that's new. Clearly, with the Davos announcement, I think it's like front and center on everyone's mind. What concerns me, although I do understand the fundamentals around why we're seeing a rotation into real and hard assets, this is really a hedge to your portfolio. At least traditionally, that's the way it's been pitched. And so when you're kind of seeing these parabolic moves in what is supposed to be a hedge, you really wonder if you're going to start to see like one-like correlation on the downside, where you would expect the safe haven type of trade to happen within these metals. If we see a pullback in equities and other risk assets, if you continue to see a collapse across. And I think that's slightly concerning and seemingly kind of flying under the radar.
So there's something very interesting. I'm going to show you guys here in just a moment. But it's actually coming from Bitmine. It's actually coming from Bitmine. So I thought it was really interesting. Shout out to Skeptic who had posted this in the Discord. Let's see. So Real Evil Duck says, Eugen Vasquez, how many times have I kept saying CPER, CREP? Sounds like a broken record now. You sound like Victor. You sound like Victor. I've picked up not CPER. I don't own CPER, but I own the mining. I think it's COP. Is what I own. So I'm going to just be increasing my my position to that. And the reason is, and maybe we can get into this a little later, but man, there's just so many damn clips on copper and energy, right? So many clips on copper and energy. Might as well just go off on a little tangent here. But there's so much like from the clips I saw, basically there's not enough copper to meet the demand for energy, right? To meet the demand for energy. All this infrastructure being built, the mines that are currently mining copper, there's just not enough in the world. If a city, if a town, if a country wants to grow, they need power. Point blank flat. They need power. They need electricity. And in order to generate that electricity, right, not only do they need the fuels for their power stations or their electricity grid, but they also need all the copper and all the metal that's going to go into that. You know, aluminum. Aluminum is also very important here. Power lines are made out of aluminum. Okay, just again, me just doing very surface level, kind of due diligence, and just, listening to others speak. I am now really, I hate to say it, and I hate to say it this way, but I'm really bullish on copper now all of a sudden, right? Because it makes sense. We're moving into this phase or this age where energy is going to be the dominating theme, because of, to support, in my opinion, not just the data centers, right? Not just AI, not just all the AI capex that's going on, but copper is going to be extremely important for other nations, right? Other nations that want to develop all that stuff. So, a data center in Europe, data centers in Europe, they're going to probably have to build stuff like nuclear is also something I'm really starting to look into. That's why I kept talking about that Chernobyl stuff, because it was just fascinating. But the other yellow rock, yellow cake, right? That's what they usually call it, yellow cake for uranium. I've been looking at the uranium miners and the uranium thesis, and if the United States is going to move towards that, it's going to take a couple of years. They don't build a nuclear reactor within a month, right? Oklo, for example, if you look at Oklo, crazy parabolic moves to the upside. They don't even have any damn reactors. They have nothing, right? As far as I know, they don't really have anything. But every investor is just piling in cash into this on the hopes that they win these contracts and they start building all this stuff out, all this infrastructure, right? Now the next kind of move is not only these large nuclear facilities, but also not portable. I mean, I guess you could call them portable, but modular reactors, right? These smaller reactors, because like if you're looking at it like and I'm going to use this as an example because I think it's the best example. But if you're looking at like a base, right, a military base that's not in the United States, for example, something overseas, something in an austere environment. They usually need power, right? They usually have to have power. When you're talking about building a massive base, there's lots and lots of electricity being used. And usually, traditionally, what they had was these power generators, right? These power generators throughout the entire base. That was the power grid. And or that's what was powering the power grid, right? All the chews, the DFAC, the offices, everything, all the lights, the air conditioning, all of that stuff was all powered by power generators. And those power generators needed diesel or some type of fuel source, et cetera, right? Until they could plug into a grid, or they had a power station on site. So the idea is that with these modular reactors, you can stand up an entire base and not have to worry about having this big infrastructure, this large power infrastructure. You could just have a modular reactor. So I thought that was actually really cool, really smart. But again, how far out is that technology, right? Are we just going to have, a bunch of little small nuclear reactors all over the place? I mean, that sounds like a recipe for disaster. And then, how are they going to service all this stuff? So again, the technology is coming, it's evolving. I think the U.S. knows that they don't, want to have a Chernobyl-like event. So it's going to be it's going to be fascinating. There was an article that came out from basically Trump asking states who wants to kind of just hold on to this nuclear waste, right? I briefly read over it, and again, that's one of the things that we have to think about as far as the United States. You know, what do you do with all the nuclear waste, et cetera? So again, very, very interesting stuff. For anyone in the chat that might be interested in something like uranium, right? Not saying that you should, but there is the Global X Uranium ETF. All right, I don't own a position in this, but look at it. You know, year to date, 27%, doing pretty damn good. Okay. It's that other yellow rock other than gold. Now, this is not a hedge. Okay. This is a bet on a theme for energy. All right. For energy, for nuclear power. So if you guys want to take a look at something like that, it might be worthwhile. All right. So moving on, this is again more towards the commodities, more towards the metals. Stanley Druckenmiller on copper. It's in the tightest position I have ever studied. He said this in 2023, but didn't take position because he believed a hard landing was coming. He was not wrong about the hard landing, but he is right about copper. All right, demand is exploding. So this is I'm guessing a fairly old interview with Druckenmiller. If you don't know who Druckenmiller is, you know, very, very famous, basically hedge fund manager. You can YouTube him, Google him. Very, very, he has a pretty damn good track record. So anyways, let's listen in.
If we get a hard landing, but one would think coming out of it, there are going to be some great commodities. Copper is in the tightest position, well, frankly, I've ever even studied. I'm actually afraid to have a meaningful position in it at this point as we approach the hard landing, only because I'm not an idiot and I know what would happen to the cyclical factors as a hard landing starts. But coming out of it, given the move toward EVs, given the usefulness of it in infrastructure spending, which I think a lot of government policies will try and encourage on their way out, it's hard to believe copper won't be a huge beneficiary. The question is, when am I supposed to buy it and how big is the exposure? And a lot of how big I would get a position like that, again, will be policymakers' response if we even get a hard landing. This isn't
policymakers' response, right? And you don't have to go very far to see what those policies have been. You know, the United States is moving towards reshoring, bringing a lot of the stuff back in-house. You know, the over-reliance on China for metals, you know, getting off of that, weaning off of that. That's what the United States is trying to do. That's why Greenland was so important. Again, they're not going to, you know, the United States is not going to go start mining the hell out of Greenland tomorrow. It's going to take some time. It's going to take some time. So there's going to be a long wait period, right? Especially if you're investing in these metals or investing in these commodities or investing in these miners, right? So it's going to take some time. But if you're a believer in that thesis, in that theme that the United States is reshoring everything, bringing everything back, you know, trying to reshore everything and stop over relying on China. Some of these ETFs, you know, have no exposure to China. Some of them have exposure to other places like Australia, Canada, South America, you know, some places in Europe, Africa, all that kind of stuff. Again, due diligence, look through the holdings of what these ETFs actually hold, and you can come to your own conclusion. I'm of the belief, especially when it comes to the commodities now, I'm a believer of it, that, you know, just the United States is moving away from China, so I don't want any exposure to China. And all of a sudden, you know, metals, commodities, there's a potential for a new super cycle, right, for these things. Everything right now is a super cycle. So sometimes you got to take it with a grain of salt. You know, everything is, you know, crypto super cycle, Ethereum super cycle, an AI super cycle, data center demand CapEx super cycle. Now you have the commodity super cycle. Everything is a super cycle right now. Honestly, it all kind of falls under the government super cycle, right? You have defense spending going up. You have the government, U.S. government, really driving policy for all of these other, you know, super cycles. So really, in my opinion, it is just a broader government led policy super cycle that's putting basically America first, right? That's what the whole policy is built on. So, you know, you can invest accordingly if you believe in those theses or if you believe in those themes. All right. Moving on, I'm going to skip these real quick. Let's see. I'm gonna skip these real quick because I wanna touch on this real fast. So this is from Bitmine. All right, you guys know who Bitmine is. BMNR chairperson is Tom Lee. But he posted this. All right, gold and silver moves are astounding and impressive. They are also sucking the oxygen away from other risk-on assets. When he says oxygen, he's talking about liquidity, right? He's talking about capital inflows, right? Money. All right, this is not bad for crypto. It is a leading indicator. I thought this was an interesting thought, right? It's not bad for crypto. This is a leading indicator. It means that the risk on is still there, that the money, the liquidity is there. It's just rotating away from equities, away from crypto and into the metals, right? Into commodities. At some point, there will be another flip, right? There will be a flip and people will move away from commodities back into equities and crypto, right? Think mean reversion. Excuse me. So again, you have gold and silver having these crazy run-ups. We covered this a lot on the last stream, talking about, you know, there's a lot of tourists out there, you know, who are going to get into these things at these levels at all-time highs. And when there's a pullback, a correction, they're going to paper hand it. They're going to get out. They're going to sell out. They're going to get flushed out. So again, you know, if you're investing in these metals, make sure you know why you're investing in them, right? You're investing in them based on a thesis, on a conviction, not just because the chart is showing up and to the right, right? Everyone loves a chart like this. Let's see. Everyone loves a chart like this. Everybody does. But when the pain comes, the inevitable correction, the inevitable drop, you know, people are selling out like crazy. And I get, oh, well, you could sell before it drops, right? Well, you could time the market perfectly. Not always the case. All right. So just checking the chat. I took 10 silver eagles to sell. Not one local dealer would give me over 65 per ounce. That is crazy. This is, you know, just to your thought, Farouk, this is kind of my thinking of why I don't hold physical gold or coins or anything. And I see Padre in here. I'm going to get to you in just a moment. But this is also why I don't hold the physical stuff, because if I need to sell and get that money out quickly, I don't want to get screwed by the people that are buying my gold, right? By the brokers. You know, I saw a strategy out there that what some people are doing is that they'll just take a loan, right? They'll just take a loan against their gold for a certain amount of time and then just pay on that interest, you know, but they can use that money to do whatever it is that they're going to do, whether they're going to flip a house, whether they're going to flip a stock, which I obviously wouldn't recommend, or invest in a high yield ETFs, right? Take out a HELOC, right? Take out a personal loan. Why not? But, you know, it's just one way of extracting value, not losing the gold, right? And then paying back the loan and then getting your gold or your silver back. But yeah, just for me personally, again, if I had, you know, 20, 30, 40, let's say $50,000 worth of gold coins and silver, you know, getting on a plane and hopping to another country might be a little, might be interesting, right? I'm definitely going to get stopped and definitely going to get searched. And shoot, I might even have to break off the security guards with, you know, a gold coin or a silver coin just to leave me alone, right? Not something I'm trying to do. But anyways, moving on, we have Padre, i.e. Victor, all right? He is pretty much the commodities subject matter expert. I listened to him quite a bit. Very, very intelligent. So shout out to you, Victor, but you need to do live training with him, Duck. Show him click by click how to do a leap and then sell cover calls. Yeah. Evil Duck. Yeah. We were talking about this yesterday. Again, I'm trying to wrap my head around the cover call stuff. You know, you mentioned leaps and doing a copper with, or doing leaps on copper. So I was playing around with it yesterday. I almost bought my first contract for a leap, for 2 years out. So January 2028 is when I was going to buy it for. But then, like, you know, obviously I didn't do it, cause I just don't even know if I'm doing the right damn thing. It was going to be for basically in the money. Yeah. So anyways, Padre also says that's literally 10 gold ounce coins. That's pocket change. Yeah. You know, and he also said manganese is ripping. I don't know what the hell manganese is. All right. Give me a chance. All right. I barely discovered freaking copper. Okay. Anyways, let's move on. Let's listen to we have for Jeremy Siegel. So Jeremy Siegel is a professor at Wharton. He also is one of the fund managers for Wisdom Tree. All right, you guys know Wisdom Tree, pretty popular funds out there. One of the more popular ones that have been gaining a lot of traction is GDMN, right? Goddamn, but really it's gold miners. But it is a crazy ETF with like a 300%. Let's just take a look at it. Why not? GDMN, all right? Let's see. Wisdom Tree Efficient Gold Plus Miners, right? This is basically doing 1.8 leverage, I guess, or futures based on the futures contracts. But let's look at what it has done. 288% over the last year, right? Just over the last year. Really good performance here. Of course, this drop right here is pretty significant, down 20% instead of what gold dropped down to was about 10%. So you can look at Wisdom Tree. This ETF is almost a 2x, right? A 2x on gold miners. There's also GDXU out there, for the 3x leverage plays if you're into that stuff, but be careful. Okay, so going back to Jeremy Siegel, let's listen in what he has to say about rate cuts. I don't think I don't know what to think about rate cuts. I'm going to be honest, because there's like the narrative out there that if inflation is down, right, the labor markets seem to be okay. They're not, there's no cracks there. We have to wait for more government numbers to come out and tell us whether, the economy is falling apart or not. That is really what's going to be driving the rate cuts. Now, if everything keeps going well for the economy, right? For the economy, people are finding jobs are being created, and everyone is being employed. That does not incentivize the Fed, and I shouldn't use the word incentivize, but that does not make sense for the Fed to do any more rate cuts. So that is one case. There's a case out there that will get at least one rate cut, especially with a new Fed coming in. But again, that won't be until the new Fed is basically put in the seat, getting Jerome Powell out of there. So when that new Fed comes in, that is when we would supposedly get that new rate cut. So 2 rate cuts is kind of far-fetched. But who the hell knows? I mean, so far this whole year, these last 30 days have been far-fetched, right? So let's listen in what Jeremy has to say.
Well, let's bring in Professor Jeremy Siegel. He is Professor Emeritus of Finance at the Wharton School of Business and a Chief Economist at Wisdom Tree, of course. Professor Siegel, good to have you. I mean, pick your spot here in terms of weighing in on whether you feel as if this long-heralded broadening of the market is going to stick with us for a while. Is it durable? And where should we expect it to go from here?
Yes, good morning, Mike. Listen, I think this has legs. How many head fakes did we have last year? Oh, everyone called it. And, we had like a week where we had value stocks, smaller stocks outperform, and then it just reverted. But I think what we've seen and it's more than just this year, through December, I think there's been questions about the Mag 7, the only AI trade. And listen, it isn't that they're not great companies. It's that are they going to be the leaders in 2026? And as you mentioned, I think the headwinds are a stronger economy that really does favor value stocks, smaller stocks. I think we've got 2 more rate cuts coming. The short-term interest rate is much more important to smaller stocks than it is the larger. I don't really expect much of a decline in the 10-year bond, but short rates do help that small sector. And then, we do have the tax cuts and others that are going to power consumer spending. We don't quite know GDP third quarter over 4. I don't know if I really believe St. Louis. They say fourth quarter is over 5. There's a lot of question. We have to learn about some gold flows, which might subtract from that figure. But we're heading into 2026 at a very, very strong rate.
It does seem as if, we finished up last year strong, and we do have some of those tailwinds on the fiscal side kicking in early this year. I guess the question I've always had about, this idea that smaller stocks and value stocks can take the lead is that they seem to obey maybe a little more of a valuation ceiling than, these world-beating growth names that have addressed these huge markets and have been able to grow at, super GDP rates forever. So I wonder if that's going to be a complication in the story.
Well, it is, but when you sell at 15, you don't need much growth to have a really good return. If you work through the mathematics, if you just even grow at the level of nominal GDP and don't super grow, you're going to get some really good returns from a 15 PE stock. Now, when you have a 30 or a 40 PE stock, you can't have that. So the leverage is so much higher on a little bit of growth to get those multiples higher and to get that good return, that this could be the year. And by the way, I think another thing that's powering it is this the year of the AI user and not just AI supply. We all know that only 15-20% of firms have really substantially incorporated AI into trying to lower costs. There is a lot out there that can, you know, talking about this is the year where costs could be cut, margins could be improved for those, and with the leverage of a low PE, they could be the outperformer.
And we are starting to hear that from companies on their earnings calls when they're talking about the ways that they're using AI in the back office functions and reducing headcount. Alternately, what's your prediction about what that means for the labor market?
Well, there is a big question there on that. I mean, if you look through the history of technology, there's always other jobs that people rotate on them. Is this going to be faster than what we've seen before? That's a question, but I think, thank goodness, we're not entering into this period in a recession. Job openings are still strong. The labor, unemployment rate under 4.5% is still one where people can find those jobs. But you think of what the margins will be. I mean, I think I've even witnessed it at my company how my commentary gets written in ways that are so much faster and more effective than what we had before we had AI, and how much savings of time and energy. And you go across firms, you could really see profit margins rise 2-3 percentage points just by moderate incorporation of AI techniques.
What's crazy is I've been watching, or not watching, I've been listening to just random podcasts, right, on AI, and there's this big fight going on, especially in the artist industry. And I'm not saying like just singers or rap artists or et cetera. I'm talking like people who like paint, right? People who do portraits and things like that. There's a huge fight saying that, they're making fun of AI artists, right? People who use AI to create their art, right? Or create cinematography or videos or things like that. They're making fun of them, saying, you're, AI slop, it's all garbage. You can't even call yourself an artist. Like, that's so stupid. Real art is this, right? We all know, at least I would hope so, that art is pretty subjective, right? But it's funny, like, so reading some of the comments on these videos, they're just like, okay, boomer. And these are pretty young people, probably millennials, right? But they hate that AI is taking away business from them, right? If you look on Fiverr, Fiverr.com, where you can get like some quick outsourced help for certain things, right? You used to have to hire like thumbnail artists, right? Actual thumbnail artists for YouTube. You used to have to hire these people, and they would charge like $30-$40 a thumbnail, right? If you outsourced to an agency, they would probably create, your lineup of thumbnails for the week, for a couple $100, if not a little bit more, right? But now with AI, it does it all for you. It could do the whole thing, right? It does it, and it's getting better every single day. Whereas you used to have like blurred words and, not just blurred words, but just words that, didn't even like make sense on the thumbnail. Now they're getting way more better, way more direct, and they're even converting better, right? One of the big things for at least YouTube or anything is the conversion rate, right? When it comes to content creation, is the conversion rate, the click-through rate, CTR. These thumbnails are getting better. They're getting more eyeballs, right? So it's interesting, to say the least, that that he brings it up that yes, it's replacing people, but so did the computer, right? So did the computer, so did Microsoft Excel, so did Outlook, right? Email, so did electricity, right? So did the car, right? There's always, whenever these new innovations came out, there was always this second camp or the opposing camp that said this was garbage, this is not going to go anywhere, it's going to steal all these jobs, et cetera. It's going to send the economy into depression, whatever. Every turn of innovation usually is met with that type of resistance. So who knows what's going to happen in terms of the broader economy, especially with these big tech companies. They're laying off a lot of people, right? Those engineers, those software developers, those people, they need to go somewhere. So they're going to have to find new jobs, right? And now you have vibe coding. Vibe coding is a big deal right now. Vibe coding, you don't even really need a software developer. You can be someone that just knows a little bit. You speak what you want, or you type it out what you want, and the AI is just going to build it for you. So it's getting better. You used to have to go to school or at least go through hundreds and hundreds of hours of self-training to learn how to program in either like, Python, Ruby on Rails, C++, if that's even still around, doing your own websites, HTML, it's just now you can do it all through AI and it spits it out really, really quick. You could build an app now, right? You can build an app through vibe coding. Again, what you used to have to do is download the Android or the Apple compiler, code the whole thing yourself in some, language, whatever the language was. And now vibe coding just takes away all of that, right? Now you can just vibe code a freaking app within a day. So it's really crazy. So I was laughing earlier because we have some news that came out. So we have from Roundhill, these bastards, 4x leveraged single stock ETFs, 4x on the QQQ. Well, this is why I believe this is fake. All right, this can't be real. Look at this, 4x QQQQ, and then 4x for SPY ETF, right? The effective day is April 8th. Is 2026, I'm guessing, is when they're going to be coming out with this. So yeah, that makes sense. Because it takes about 2 to 3 months to actually get an ETF launched. This is crazy. The SEC had already come out and put a halt on any new funds dropping that are leveraged, right? That are leveraged. Obviously, yieldmax was the one that was called out, that was name dropped. But you still have Granite Shares. You still have all these other fund managers that are, basically got the pause button put on them by the SEC. And there was an article, I'm not going to spend any time finding it, but there was an article that came out. And basically the reason was because a lot of these funds, and they say it right there in the article, underperform their underliers, right? That's just what happens. And then not only that, you have to think with all these leveraged funds coming out, that could send equities higher, right? The underliers higher, but it's when there's these sell-offs and people get out of these funds that just causes a bigger drop, right? I've heard, correct me if I'm wrong, but I've heard this before, that the biggest market crashes or corrections are usually due to leverage, right? Usually due to leverage. And now we're coming out with 4x, 400% exposure to the Qs. So if QQQ moves up 1%, your ETF, whatever this ETF is going to be, is going to move up 4%, right? I mean, it's not that big of a move. To move an index 1% is a pretty big deal. To move SPY up 1% is a big deal. So this is just crazy. Yeah, shout out to you, Skeptic, and Bobo. I don't know if he's listening in on the stream, but yeah, that is crazy. I was laughing as soon as I saw this. Okay, let's move on. There's a little bit by Tom Lee. All right, we're gonna move into the crypto stuff. We're gonna skip this video. I think we've talked enough about precious metals, but we're going to move into this segment, just a little bit about crypto, and then we can move into probably some ETFs. All right, finish off this Friday. All right, for me, it's Saturday morning, so I got some stuff I got to do. Anyways, David Sachs, White House crypto czar, notes that after passage of legislation, digital assets and traditional finance institutions are converging. Okay, we already see this with a lot of these big banks, coming out their own stable coins, moving on to the Ethereum blockchain, moving on to crypto rails. So we already see this happening. This is positive for properly built blockchains and DeFi. All right, I don't know too much about DeFi, decentralized finance. I don't even know the coins that are involved with DeFi. Maybe Solana put it in the chat if you guys know. I certainly am not that educated on crypto. To me, further validation that Ethereum is a central character. Ethereum, BMNR, Bitmine. All right, so let's listen in what David Sachs had to say.
A good compromise is everyone leaves a little bit unhappy, right? But I think what's going to happen is that after market structure passes, the banks are going to get fully into the crypto industry. So we're not going to have a separate banking industry and crypto industry. It's going to be one digital assets industry. And I think
will they be regulated
their opinions are going to evolve over time. And I bet you over time, the banks like the idea of paying yield because they're going to be in the stablecoin business.
But will they also be regulated the same way? And I guess that's a big, the banks will say, hey, if they get to do all the same things we do, how come they don't get regulated the same way?
Well, I guess because they're offering slightly different products, right? Yeah. So, but everyone offering the same product should be regulated in the same way, and we want to get to that harmonization. A good compromise is everyone leaves a little bit.
So there you go. There's not going to be a crypto and banking sector. It's just going to be one combined sector. And we already see it happening now. there's a thought that, once this Clarity Act gets all taken care of, it gets passed, it gets signed by the president, that, crypto is going to have a big rip, right? Maybe that'll be the catalyst that sends Bitcoin up. And even you have to look at Bitcoin and you have to look at Ethereum and some of these other projects. It's like, what are they? Because the narrative has changed for these, and definitely like how investors classify them, right? Because, Bitcoin used to be this really, or it still is, this super highly volatile like trading thing, right? And this coin, this bet against fiat currencies. It's always been that, slowly evolved into like digital gold, and then it evolved even further to, being a store of value, right? And, you look at Ethereum kind of in the same way. Now, what is Ethereum doing? What's the blockchain doing? Maybe this is where Wall Street heads, is where TradFi heads, is to build everything off of the Ethereum, blockchain, which could be bullish for Ethereum. All right. So you just start looking at this stuff, from kind of like a 10,000 foot high view. And it's really just, I don't know what is going to happen to a lot of these other coins, a lot of these other, like altcoins and shit coins and things like that. I'm fine with holding just, Bitcoin and, something tied to Ethereum, like a BMNR. When this legislation gets passed, right? When this gets passed, what does that actually mean for these coins? Right? What does that actually mean? How is it going to be a good tailwind for them? We saw from Brian Armstrong, who's the CEO for Coinbase, he was basically saying like this is going to be bad for stable coins and for rewards, right? This would be a bad bill. Whether they changed it or updated it, I have not seen any news or movement on that. But he was very anti whatever that bill, whatever the Clarity Act currently in its current state had, the current draft. So is this going to be more better for stable coins, right? Is this going to be, like way better for stable coins? Is there some tailwind, some bullishness for Bitcoin? Recently, was it Scott Besson, I think, or it was probably Scott Besson. He was saying that, any seized Bitcoin is going straight into the United States Bitcoin Reserve, right? It's going straight into the Bitcoin Reserve. So that is going to be one entity that never sells Bitcoin. You have Strategy, MicroStrategy, Michael Saylor, they say they're never going to sell their Bitcoin. At least the idea is never to sell their Bitcoin. And then you have, just regular everyday people that just refuse to sell their Bitcoin, the hodlers, right? The Bitcoin hodlers. So what is this bill going to do to Bitcoin? Is it even bullish for Bitcoin, right? Now we're getting into the whole theme of like the 4-year cycle. Is the 4-year cycle with this mass adoption, right? With this mass adoption, you have banks that are now allowing you to take loans against your Bitcoin, right? They're allowing that. In the past, they were so anti-Bitcoin, you couldn't hold Bitcoin. If you bought Bitcoin using your credit card or your debit card, this was back in 2018. So this wasn't that long ago. They were shutting accounts down, right? Because you were buying crypto. Like, think about it. Now they're saying, you know what? You can buy all the crypto you want, and we'll even let you take a loan against your crypto. Which is just crazy, right? Just absolutely crazy. And the industry, the sector is evolving extremely fast. So going back to the 4-year cycle, are we going to see the traditional 4-year cycle or not with this really broad mass adoption of Bitcoin, right? More and more people are starting to add to it. You still have, institutions that deal with, personal finance, wealth building, that kind of stuff. I forget what they're called. Like your finance planners, your financial, advice, all those types of people, the advisors, they're going to start recommending people put Bitcoin on their net worth, right? Put it on their investment sheet, have a small allocation, a 5%, a 2%, a 3%, whatever it is. I mean, imagine how much inflow that is. And it's not directly to the Bitcoin, like actually holding it on a wallet and all that. It's probably going to be IBIT. Right? It's probably going to be some type of IBIT. Maybe it'll be, the other spot price Bitcoin ETFs. You have Grayscale out there. You have Fidelity with their own version of IBIT. And you have Morgan Stanley that's coming out with theirs, right? So you're going to have all this passive inflows into Bitcoin, and they're going to allow it for retirement accounts, right? They're going to allow it for retirement accounts eventually at some point. So, well, they already kind of do, if you have like a self-directed 401k or a 401k that offers IBIT, which I don't know if they ever do, but that is just one other way where all this inflow is going to come from, all these inflows. So still very bullish on Bitcoin. Whether this Clarity Act gets passed, I don't know if it's going to be a super bullish sign for Bitcoin. It'll definitely be bullish for probably Ethereum and definitely for stablecoins in general. Again, stablecoins, they're not going to grow, right? They're not moving up and down, but there are rewards tied to holding stablecoins. And, this is the U.S.'s broader strategy of forcing companies, brokerages, things like that if you're going to have stablecoins, they have to hold U.S. treasuries, right? They have to hold U.S. treasuries. So it's one way. Okay, guys, we're pretty much past most of the news segment, pretty much all of it. All right. I think we covered quite a bit. You guys got to hear me just yap on about nothing, about nonsense. I just want to point this one out. So TDAX, a shout out to you, Skeptic. TDAX had its first distribution. All right, this is we spoke about TDAX not too long ago, but you have TDAX, which is a lift series powered by Tap Alpha, and this is on their TDAC. All right, on their TDAC. All right, so if you guys don't know what TDAC is, it's just your vanilla income ETF, right? I mean, they have a couple innovative strategies in there. Some people like Cy, who's doing most of the trading. Cy is the fund manager, and he utilizes AI to help him come up with these trades, right? So been working very well, right? They've been very well received. A lot of investors do like these series of T-SPY and TDAC. So they just had their first distribution. Now, the TDAX is basically roundhill, right? Using the swap agreements. That's the strategy that they're using. It's 1.3 leverage on TDAC or T-SPY, right? Because they have two lift series. And so you're just getting the gains returned to you in a distribution, right? So you're just getting the gains returned to you in a distribution. So they just had their first distribution, and it came in at 27.31%, right? That's their distribution rate, but this is their first one. Okay, I think it's a very interesting ETF. I am watching it closely. I may even at some point in the future think about using something like this. I have XPay. XPay has been phenomenal for me. I like XPay. I like keeping XPay. I don't have any intention of getting out of XPay, but I do like something that's index-based, right? I like something that's index-based that isn't a degenerate Forex QQQ. But I like income ETFs, for the stability, since they have like the index as the underlier. So this might be something I keep an eye on. Of course, I still think there's going to be that dramatic, 13, 15, 17, maybe it's a 10% drop in the market, in the broad market. Maybe it's not going to be a sharp sell-off, right? Like we saw on Liberation Day. Maybe it'll be a grind lower scenario for maybe a couple of months. But that is really when I want to open a position. When I see that really big drop on the S&P 500, that is when I would probably consider something like a TDAX. For me personally, there's been a lot of people have been very, very happy with GDXW, and GDXW. This is a Roundhill's gold miners ETF. A lot of people have been really happy. No DAV erosion, right? It's been going up in value because GDX has been going crazy, right? GDX, the ETF, has been going absolutely crazy. But this is also something that I kind of toyed with. I don't think I'll honestly be buying into this as much as I like the Roundhill stuff. I don't know if I'll be buying into this one specifically because I'm not trying to look to extract cash or extract value from the ETF, even though it does grow. Like if you look at the charts, it has been keeping up with GDX while still distributing a pretty healthy amount. So, I mean, it is an interesting ETF. I do like it. It's just not something I want to be involved with in my portfolio at this time. Because GDX, when you look at it, it is, and I hate to say it this way, but this is the way I like to look at it. It is pretty much a leverage play on gold, right? It is a more volatile, ETF. GDX is. It's a more volatile ETF than just holding spot price gold. So Yeah, and Skeptic, I see that you mentioned ISGB or ISBG. I saw those too, and we've talked about those quite a bit. We'll pull it up right now because I was just looking at that, and this is from Quantify. So everyone's looking at these two right here. I foolishly did not know that at first that these were actual like cover call or option based ETFs, income ETFs. I foolishly thought that these were just growth ETFs. I thought this was this, right? I was thinking of it like this. So actually looking at it and reading the product page, I was like, oh wait, these are option income ETFs, right? These are going to be distributing soon. So, just looking at it from a high level, right? Income Architect, I believe, has already done a video on this and has been really, really good. I haven't had a chance to actually go through the whole thing. I know Marcos Mila, another YouTuber, he's done some stuff with this as well. So, if you want more of that deeper dive, that deeper look at these ETFs, those are two YouTubers that usually pump out pretty decent content that you can look into. So just my two thoughts is all, giving them some a free shout out. So yeah, a lot of people are looking at this one because you're going to get that really nice growth, right, with Bitcoin and gold, but you're also going to be getting that distribution. So that would also be nice. Let's see what else we got. Yeah, ISSB, which is stocks in Bitcoin. So the other one was gold in Bitcoin. This one is stocks in Bitcoin. Now I saw a post from Income Architect. And he was saying that these would have far less NAV erosion or no NAV erosion because of the way they're constructed, right? Because of the strategies that they use and because it's a one delta, if that makes any sense to you guys. Basically, it's not going to be trading with the index, right, or with the underlying. So that should be good. So again, is this something you guys might be interested in? I mean, you guys let me know in the chat. I mean, this is a pretty decent expense ratio. This is like, an Ulti's expense ratio. Usually they're about, or a WPay expense ratio. Usually most of these income funds, they hover at about 99 basis points. So 1.29% is usually the way I look at it, is like, this must be a premium strategy. This must be something really good. But the net expense ratio is 1.14%. So it looks like, it's because they reduced their management fees until March 31 of 2027. So yeah, that makes sense. That's usually what these fund managers will do, especially for their more premium products. They'll lower the expense ratio for the first year, or the first 2 years, it looks like. No, first year. March 31st, 2027. So they'll lower the expense ratio to get more investors to come on board. Again, I don't like jumping into things just as they drop. I like to see how they play out, over a couple of months. And I mean, I'm in no rush to be, hopping in and out of ETFs that do distributions. I'm just not in a rush, right? So I like to just see how this will handle, because as we saw with a lot of these ETFs, a lot of the income ETFs, all in, right? Go all in on WPay, all in on Alti, all in on msty. And then, surely just a couple of weeks or a couple of months later, everyone's getting out and, these ETFs suck. The management sucks. They're losing all their trades, or there's too much NAV erosion. It's like, well, is it NAV erosion, or is it just because the whole market's been going down? So anyways, I don't want to get into that because I won't shut up about it. But yes, TDAX, keeping it on the radar. These, according to Skeptic, a lot of people are waiting for this to see how this is going to play out. And I think that's probably the smartest thing to do, is just kind of wait and just wait for the sentiment to come out, because you're going to see it in YouTube land. You're going to see it in X land, right? Everyone's going to be all excited about these funds. Oh, they're going to have their honeymoon phase. Everything's great. But when that inevitable drop happens, if it happens this year, I think it will, people are going to be pissed off, and they're going to say, oh, these suck. These are NAV eroding ETFs. They dropped to their value, the price of the fund dropped. I don't like it. These should always go up and to the right, while also distributing a large amount of money. So yeah. Anyways, guys, I won't shut up about that stuff. But yeah, we're pretty much at the end of the segments. All right, we covered a couple ETFs. I think we covered the quantified funds and the tap alpha stuff at least twice on this stream. So, all Are you guys, do you guys have any other ETFs you want to drop? Drop them down below in the chat. We could take a look. Is there any questions that I can answer for you guys? Again, I'm here easily for the next, 15, 20 minutes before I end the stream, and I'm here for you guys. So you tell me. Got to finish off my coffee here. Damn birds. Birds are loud today. Man, they're loud. They're fighting out there. Let's see what else we got in the news. Let's see. Robert Kiyosaki. We got retire on dividends. Mia. We've already seen that clip. Copper, your millionaire ticket. See, all of these new, like I'm telling you, there's going to be a ton of tourists that are going to come into these funds, and they're going to probably be either pleasantly surprised or really, really upset, because we're in the euphoric stage right now. Andre Brown, hey, welcome. I have a few shares of ISSB and ISBG, but I am looking forward to the ISSB or ISSG stock gold. The fund manager was saying they should yield anywhere from 20 or 12 to 30%. Yeah, I mean, I think most funds that I've seen that have been at about that 30% have done really well. Cepi is the best example I can give you, even though their distribution rate has actually been climbing because SMH has been doing so well, or the underlying, the semiconductors have been doing so well. But, obviously, especially in the high yield space, 12% to 30%, that's usually been kind of the sweet spot where you're going to get at least flat to moderate growth. And a decent distribution, right? I think the days of the 100%, cover call ETFs, I think those are coming to an end. Not to say that, yieldmax is, single tickers are all bad or anything. I'm just saying that investors don't want to see red. It's a psychological thing. They don't want to see red in their portfolio, even though they're getting a distribution, a shrinking distribution. And then you tie that in with, like something like a Granite shares where, yeah, they're pumping out 150% distribution rate, right? But at the cost of your principal, right? You have to wait basically a full year to come full circle, right? To reach house money and then everything after that, right? So it depends what you're going to be doing with that distribution, right? A lot of people are using them. They're using it as like a feeder sleeve. So what they'll do is they'll have like the high yield stuff as a feeder sleeve. Basically, they take those distributions and move them into safer plays, right? Safer assets as it is, things like an index. But also like Perry, I don't know if anyone's from Canada and knows Perry, but I put a clip of him in our Discord because I thought it was really good. Like he shared his cony position, right, with YouTube. So let's take a look, and maybe you guys can come to your own conclusions about this. But I thought it was just a really well done video. It's really short. It's like, a couple minutes, but let's listen in. So this is exactly how people, I shouldn't say how they should do it. This is what he did, and it worked for him. And I'm in agreement with how people should look at these really super high yield products. They should use the distribution responsibly, not go blow it at the club and try to buy a Lambo with it, right? Because these things aren't always going to pay what you think, and there is always the risk that comes with these. But let's just listen to what Perry had to say. Perry, I don't know if he'll even watch this stream, but shout out to him. You guys should definitely check him out. Perry's PII. Yep, Perry F PII. That's his channel. So let's listen in.
Hello everybody, my name is Perry and welcome to the Pieverse. This is a video short. I'm doing it because this was a memorable day today. Effectively today, I made my last 3 sales of cony, which closed out my entire cony position out of my portfolio after holding it for 2 years ago this month. So I DCA'd into it. Sometime about a year after, early 2024, I reached a peak investment of $101,186 in book NAV. I basically sold it for, after all my sales over the last month and a half, of $26,997. So I basically had a capital loss of it of $74,189. But
all right, you see what I mean? A capital loss of 74,000. And that would be enough to freak out anybody, right? Get out. Oh, yieldmax sucks. Yieldmax is garbage. It's single ETFs. I'm done with them. I'm moving to roundhill, right? Roundhill. And now everyone's like, oh, screw roundhill. I'm moving to NEOS, right? And eventually it's going to be something else, right? Or Granite shares. I'm going to move to Granite shares. And then Granite shares sucks. I'm moving to NEOS and I'm moving to Kurv because those are the safest and those are the best, right? But they've always been good. It's just people did not like that they had such low distribution rates. Anyways, let's continue.
That does not tell the whole story. My total distributions of Cony over the 2 years were $94,146. That makes Cony, and the to date, still the largest contributor to my portfolio in distributions over any of the dozens of ETFs I had. None have come yet to close to that number. It basically, when you add the 94,000 of distributions plus the 27,000 in residual NAV after the sale, I basically had a total gains of 121,143.
So there you go. All right. So you held the ETF long enough, even though he had a lot of capital loss, right? But he still came out way ahead. And then he's going to explain what he was doing with those distributions. He wasn't, you know, I've seen Perry's before. I've seen his interviews. I've seen his content. He published a really good video on kind of how he looks at his portfolio and the ETFs that he has. It's similar to like a core satellite approach, but he has way more definitions, more specific definitions for each of the different types of income ETFs, right? You know, you have your cores, your stable assets, the ones that, you know, go with an index, all the way up to like a moderate yield, right? And then up to the highest yield, which are typically the highest risk, right? So he kind of gave some thoughts on what you would do for allocations. I thought it was a really well done video. I'm a big fan of frameworks, right? I like systems. I like when things, you know, make sense, like when, you know, like for a portfolio versus just having a portfolio of like, you know, 20, 30 different high yield ETFs. It makes no damn sense. Like, you know, you'll have like Maggie, you'll have like YMAX, and then you'll have like MAGs, and then you'll have, you know, individual Google, GOOW, you know, Apple W, whatever. You'll have all like just, it's a mishmash of ETFs, and it looks like the person's just chasing yield. Like, I like frameworks. I like organization. His video did it exceptionally well. So check him out if you haven't, but let's listen to the rest of this video.
Which gives me a ROI after closing of 19.7%. That's a total net profit of 19,957. Absolutely have nothing to be sad about. Cony did so much for me. Not only the fact that I actually closed it out in a positive 19.7%, but what's more important is the intangibles. That 94,000, more than half of it was redistributed into several other ETFs. Many of them are generating and will continue to generate income, compounded income for years to date. So not only was it 94,000, but its baby distributions are going to continue to grow and continue to generate income in the years to come. So I'm very, you know, a little bit sad to see Cony go, but it was its time, and it was time to move my my residual cash into other ETFs, like generally COIW, BLOX, and WPay is where generally most of the proceeds went to.
No, Perry, stay away from WPay. No. But there you guys have it, right? So basically what he was doing was moving the distributions into other income funds, right, to continue compounding his income. That's been pretty much the play for most of these income products. And, you know, like, I mean, it worked out for him, right? So these, you know, the yield max stuff can work, right? It's just, what are you using it for? What are you spending the distribution on? There's, you know, of course, other people out there that were taking that distribution and on video too. Like this is public knowledge. I'm not going to mention them or name drop them because I don't want to seem like I'm insulting them. but they were saying that they're paying their bills with it. You know, they're not reinvesting any of the money. They don't think that they need to, that these are always going to pay out. You know, $10,000 on 100% yield a year. That's $10,000 I'm going to get for the rest of my life, right? Just a horrible way to look at it. Zero risk management, just zero awareness of finance, right? Of the stock market, of Wall Street. So, you know, I think he played it well. I think this is a great example of someone who, you know, looked at it, knew exactly what to do with the distribution. There's nothing wrong with, you know, taking some of the distribution, spending it and, you know, buying stuff, paying for a vacation, right? But you should, I think, still be reinvesting that money for sure. Jay Petrocelli, you know, one of the spokespeople for yieldmax, has said a lot in the past that, you know, back in the day, you know, the highest yielding products, right? The highest yielding stocks, you know, like 10%, 8%, you know, mostly mortgage REITs or income funds. You know, this is way back. Retirement, people who are in retirement, you know, they'd be happy with a 5 or 6% yield, right? Some people would need about an 8% yielding dividend portfolio, like to live off of, right? Off of $1 million, right? So now, right, what he was saying was you could take, instead of, you know, you get a 50% distribution, live off 10%, reinvest that other 40% into something else or back into the fund if you're worried about NAV, right? So I think he played it very well. Like I said, Perry, I think he played it very well. I think that's the way it should be done. That's the way I follow. That's exactly what I did. I take a lot of my distributions and reinvest it back into the portfolio into, you know, either more growth assets or other income funds. You know, so that's pretty much been my playbook. I do use some of the distribution to live off of, right? Because I'm out here. So, yes, tradesman, you're right. And eventually, is dropping your cost basis, and eventually you'll reach a cost basis of 0. And I see that we just disconnected on the live stream, so I apologize. You guys probably missed some of that. But yes, when it comes to ROC, if you understand ROC, especially for U.S. customers, for Canadians, I'm not sure, but for at least U.S. customers, if you understand ROC, you'll understand why it's a very powerful tax classification. In real estate, right? Real estate investing, investors love ROC. Right? They love return of capital, because what they do is they take that capital and go reinvest it into another building or go reinvest it into another real estate property, right? Meanwhile, they still hold the asset. They still hold the original asset, and they're still making money off of that asset. So again, I don't understand in this space why ROC all of a sudden was bad for investors. But, you know, to each their own, different strokes, different folks. All right. Real Evil Duck says 19.7%, but he also has it in the tax advantage fund. In the brokerage, it would bring it down to 12%. So why would you do it? Good point. So comic book says, do you think investing is mostly skill or luck? Absolutely 100% needs to be skill. If you don't want to put in the time to get the skill to pay the bill, then you could just go with an index, an S&P 500, right? QQQ, SPY, VOO, VGT. You can't screw that up, right? So it's not skill or luck. It's just how much time do you want to put into investing? And I think that is a really good segue to this is, you know, when it comes to investing, in order for you to get those outsized returns, right? I think skill plays a huge part. What goes into skill? Hours and hours and hours and hours of due diligence, of content ingestion, right? Constantly reading, you know, reports, following people, you know, listening to videos, hours and hundreds of hours of that builds that skill, right? Now, what are we talking about? Are we investing or trading, right? I'm going to just talk about investing here. So tradesman, I think it says I'm on mute, but I think it's just because my internet may have cut out. Yeah, I think my internet cut out. You might have to refresh. Can anyone else hear me? Yeah, sorry, I got to pause right here. I want to make sure that my internet has been kind of trashy. Okay. All right. So anyways, yeah, going back to the skill luck thing, you know, if you want those outsized returns, you're going to have to take some outsized bets, right? And you're going to have to have the skill for those outsized bets. Now for the, skill, like, again, what comes into that, hours and hours and hours of due diligence, how much time do you want to dedicate to this stuff, right? For me, I think I dedicate a lot of time, right? But I talk to other people and they put in basically it's their full-time job, right? But they're also not working a full-time job. Full-time investing is their job. It's how they make their money, right? But they're putting in an insane amount of hours, right? But they're also getting really, really good returns, right? Really, really good, stock picks. But, I'm not saying that if you just do that, you'll always get that, right? That's guaranteed. No, not at all. But I'm saying you can become a sharper investor that has that skill set, that invests in better picks, versus just, watching a YouTube video of a 21-year-old, right? and then following that advice and then losing your money, right? There's that type of stuff out there, that type of train of thoughts. Like the better educated you get on like a sector or investing in general, the better you get, or the more reading, the more content you consume, the smarter you become. That is how you develop that skill, right? That muscle. Like for me, I could talk about 100 things about the index, right? But that's because of all the information I consumed. Of all the content, all the books I read, right? Just S&P 500, 10% returns, inflation adjusted since 1920, blah, 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 500 large cap stocks, right? But when you start consuming other content and you start, learning how to build a thesis, right? Why would you buy this? What would invalidate your thesis? What do you think is a bull case for it? What do you think is a bear case for it, right? What is the risk? What would change your mind about investing in this, right? When would you sell? Would you, when would you buy in, right? When you start asking yourself these questions, that's part of building that skill set, right? That muscle. And then, again, the rest is just looking at reports, looking at earnings, looking at their balance sheet, right? Their financial statements, and then seeing what the story is or the narrative is around this company or this pick or this ETF, and seeing how does it play out, right? And then making your buy. I think, again, a lot of people, especially in the high yield space, was buying ETFs that they didn't fully understand what it was that they were buying, and then they were being upset about it later. Same thing goes for even single stocks, right? BMR is taking a huge hit right now because of their last conference, and a lot of investors were pissed. A lot of the YouTube videos were coming out, right? Because they were like, oh, didn't expect this from BMR. Why are they doing this and that? So again, I'm part of that crowd too. I mean, now I'm still bullish on BMR, and the only thing that would invalidate my thesis for BMR is if Ethereum just goes to zero. That's really it. If Ethereum goes to zero, then the investment is dead. The investment is gone, right? Nothing's gonna turn it around. But I'm bullish on what's going on in the macro, in the broader scheme of things, right? TradFi is moving onto Ethereum, right? We already covered the banks that are moving onto Ethereum. So that's why I'm bullish for BMR. Let's see. Yeah. Skeptic says you can't just throw stuff in your portfolio, right? You can't just be buying up every single ETF, hopping in and out. Again, I think that probably harms your returns. Some people make it work. Some people have trade swung yieldmax products and, these roundhill products and all these other high income leveraged funds. They made it work. They can make it work. I just don't want to do those tradings. I don't want to do those trades. Trading is not something really I'm very fond of doing. I will do a swing here and there. I might even do a in and out trade, for the day, for the hour, but it's not something I'm passionate about doing, right? I don't like doing that stuff. So that was a very long-winded answer for, do you think investing is skill or luck? Again, some people get lucky in investing, like the early people for Bitcoin. Those are probably the luckiest people, right? If you had 100,000 coins in Bitcoin, way back when it first came out, and you held on to those coins, that was pure luck, right? That for sure was pure luck. Everything else, when it comes to like stocks and equities, I think if you want to be a better investor, you gotta develop that skill. Padre says, remember, you can only write off $3K for tax loss harvesting, and if the yield consists of money that's not 100% ROC, then you're being taxed at regular short-term gains. So his 19.7% isn't that great. I don't know his situation though. Like this is a blanket statement. and not to argue about it, but it is a blanket statement. We don't know everything about him. We don't know his whole, whether this high yield stuff is just, a sliver of his total portfolio or his net worth. I've seen his portfolio. He has it on Blossom. He has a ton of positions. And he had talked about like his priority is income generation, period, like bar none. Like that is what he's focused on. So a 19.7% for an income fund is probably good enough for him. Again, it might not be good enough for you, it might not be good enough for me or for other investors, but for him, it's phenomenal. It's probably a really good turnout. For me, I don't know, for 2 years, 19.7% for a total return, right? We're talking total return. Excuse me. Let's go back here. Yeah. For a total return, I don't know. I mean, would I be happy with it if it paid a distribution, 19.7%, over 2 years? I mean, I don't know. I honestly don't know. I would like to get my high yield ETFs to zero cost basis. Honestly, get that full return out. And then, I don't care really what happens to the ETF. I really don't. It can go to zero at that point. I've already extracted all the cash. And I've already put it into their other assets. The way I look at it, honestly, is if the ETF, right, especially the roundhill stuff, because let's talk about it, especially the roundhill stuff, because if they're taking a beating, but the strategy still works, the strategy still holds up, right? That's really what I'm betting on, is the strategy is going to continue working for the weekly pays. As long as the strategy keeps working, the stock is still, solvent. It's still there. And I don't mean the ETF. I mean the actual stock, is still there. Hood is not going to zero. Palantir is not going to zero. I could care less if these reverse split. It does not affect me one bit. As long as I can continue making some type of distribution, if my cost basis goes to zero, I'm fine with that. I can get taxed, right? Whatever the capital gains tax will be on those distributions. I have not heard a solid answer of whether those will be capped or whether those will be taxed at long-term or short-term. I've not seen definitive, guidance on that. So I'm going to be learning this myself. I've seen other people go over their tax stuff, but they don't really go over their tax situation, especially when it comes to these cover call ETFs or these, swap agreement, high yield income ETFs. So again, left to be seen is all I'm saying. So I see Citizen of the Year, which is the most wanted man. Short term, it's 30% skill, 70% luck. Long term, it's 70% skill, 30% luck. And I definitely agree with that. All right. And he's talking about when it comes to investing. Citizen of the Year dropped a factoid. It is the fourth coldest day in U.S. history since 1996. I wouldn't know. If I could turn the camera, I would show you that it's a nice sunny day here in Southeast Asia. And I'm probably going to be going out for a walk here in the not too distant future. The weather has been really, really nice here. Not really humid. It's been nice and warm, getting some sun on the skin, some vitamin D. So that's always been nice. All right. So, excuse me. Padre says, I literally bought the periodic table of Ogleheads, the debasement trade. Yeah. So again, Padre, he's big commodities guy. And he pretty much owns a stock for everything on the periodic table. So yeah, I mean, how can you lose, right? How can you lose when you own the whole periodic table? That would be good for an index, right? That could potentially be good for an index, for a commodities. Just own the periodic table. Like they need an index like that. Okay, guys, I've been yapping on for about an hour and a half now. I think I'm going to call it here. But for Saturday, I might run a stream, right? I'm going to work on getting the StreamYard stuff squared away because I would like to bring on some guests. So Citizen of the Year, Skeptic, Padre, Evil Duck, Tradesman, any one of you guys. If you guys want to come on, shoot the breeze, we absolutely can, okay? Definitely going to open it up to everybody. And if I don't do it on Saturday, maybe it'll be for Sunday, right? Maybe it'll be for Sunday where we could just get on, kind of shoot the breeze, you know, just talk about investing, right? Investing in finance. I think that'll be pretty cool. All right, guys. Well, with that being said, as always, I appreciate you guys joining me on this channel. I appreciate you guys spending some of your time watching me yap on. Hope you found some of the content in this stream valuable. And as always, you guys have a great rest of your night, great rest of your day, wherever you are in the world. Enjoy your weekend. I will see you guys in the next stream. You all have a good one.